And then the two developer groups, even though they both write code, so there's protocol developers and application developers, they have different powers and incentives. So protocol developers focus on, maintaining Bitcoin itself. They also, generally their incentives are going to be more aligned towards stability and security. Kind of like Steve mentioned, almost all changes are keeping it performant as it is, not actually implementing consensus changes. Application developers, they're building things like wallets or other layers or things that can fit on top of Bitcoin in various ways. Their power is different because they're not changing the protocol. They're not merging changes into the protocol. But they are generally more inclined, on average, toward benefiting from more features of the network because that gives them a bigger design surface to build or to improve whatever it is that they're working on.
Lyn Alden clarifies the complex dance of monetary changes, fiscal policies, and their significant effects on Bitcoin as global markets experience previously unheard-of volatility. Bitcoin seems as both a hedge and an opponent in a time when economic uncertainty drives asset flows and inflation fears are widespread. Lyn Alden explores closely into the elements that have shaped its course, emphasizing the crucial part that liquidity cycles play, institutional acceptance via ETFs, and the steadfast power of decentralized ownership. Alden stresses that individual Bitcoin holders who protect the network's decentralization have the real power, even while big entities like BlackRock compete for influence with their substantial holdings. Bitcoin's future will be shaped by the struggle between centralized forces and grassroots acceptance as budgetary deficits rise and regulatory resistance increases. Watch till the end to learn how Lyn Alden's observations about the deep relationship between macroeconomic realities and Bitcoin's price, fundamental ideas, and future trajectory are presented. Please hit like and subscribe for more daily content. Let's hear her following words.
So in the paper, we broke it, the stakeholders up into 6 different types of groups. So it's probably best to start at that high level. And that's because there's no one type of entity that has all the power in Bitcoin. It's delegated out. And there's different actors with different powers and different incentives that are operating as part of this consensus mechanism. And so the 6 groups are, the first one is economic nodes, like you mentioned. The next one is investors, so people that hold significant amounts of it, or many people that hold smaller amounts of it. Then there's miners. Then there's influencers, anyone with a significant audience within the space. And then there's 2 types of developers. There's protocol developers, and then there's application developers. And for economic nodes, we made that distinction because, even though you could be running the same node software as someone else, some nodes are more impactful for the network than others by orders of magnitude. And it's largely related to how much volume that they're doing and how much, impact they're having on what people define as Bitcoin. When they exchange one coin for Bitcoin or fiat for Bitcoin, those economic nodes, whether it's exchanges, brokers, payment processors, they're playing a pretty significant role. So, for example, what software, Coinbase or Binance are running matters more than what my node is running, especially if I'm not doing very many transactions. If it's just kind of running in the background, not doing much, those 2 nodes have different levels of impact on the network. So for that one stakeholder group, economic nodes, we kind of go into their different types of powers. And when we broke these 6 groups up to kind of identify what are the groups even are, we could have landed on different numbers. We could have found that there were 5 groups or 7 groups. The way we went about this was saying, every group has a power, and then every group has, or a set of powers, and then every group has a set of incentives to use those powers. And we define groups differently if they have a sufficiently different set of powers and incentives. And so economic nodes, they have a different set of powers than miners. Investors have a different set of powers and incentives than both of those groups, and so forth. And so then the paper kind of explores the interplay between those 6 groups and how their powers might be different in the case of a soft fork versus a hard fork. And their powers could also be different as a fork progresses. So the kind of the proposing of a fork versus the implementation of the fork versus potentially a rollback of the fork, that kind of whole life cycle of how a fork could go, those different groups have different levels and types of power throughout the process of the change. For investors, they're arguably the most powerful group of all the groups. If there's one that has kind of full control in the long run, it's eventually them. And that's especially true for a hard fork. So for example, when Bitcoin and Bitcoin Cash split, investors can sell the coin that they don't like and use it to buy more of the coin they like. They can also even participate in futures markets if exchanges set them up ahead of a potential fork, which can determine whether that fork even occurs or set up the probability of how that's going to go. During a soft fork, we found that investors, their power is quite delayed. So when a soft fork is being proposed, when it's being activated by nodes and miners, and that whole process, investors are only able to access indirect power. They can fund developers, they can fund advocacy, but their coins are not yet impactful during a soft fork process or lack thereof. And so that's basically one big power block right there.
Lyn Alden identifies 6 major players that are influencing the decentralization of Bitcoin: investors, miners, influencers, protocol developers, application developers, and economic nodes. Every group has a distinct function in preserving the power balance within the network. By controlling transaction volumes, economic centers like exchanges have considerable power, and investors, particularly at pivotal times like hard forks, can affect market dynamics and the long-term trajectory of Bitcoin. Miners are essential because they implement soft forks and decide which transactions are included, while protocol developers have the authority to veto updates and choose which modifications are accepted. Influencers mold public opinion and frequently steer consensus in crucial discussions. By expanding upon Bitcoin's architecture, application developers encourage innovation. Alden's research emphasizes the delicate balance between different groups, where no single entity predominates, yet all are necessary for the decentralized future of Bitcoin. This ownership and power allocation will determine the network's course as it expands. But that's not all. Let's get back and hear her following words.
Miners are obviously a pretty big power block. They have the ability to determine what transactions go into a block as long as they're meeting consensus rules. They have the power to implement soft forks. A fairly small set of mining pools could implement a soft fork, even if the nodes don't agree with it. It would be and we'll probably get into that later. That'll be a fragile soft fork. It's almost like a majority. It's a filtering. It's not a fully adopted soft fork. But they have the power to basically either adopt one or not adopt one. And of course, they have a set of incentives. They want stability in the network. They want to maximize the value of what they're mining, and a whole other set of powers and incentives. Influencers, especially during 2017 when there was a lot of contention around soft forks and hard forks, influencers can play a pretty big role because they can shape opinion of whether a consensus change should be made or should not be made. They can amplify some of the more technical voices that have smaller audiences, or they can counter amplify them. They can basically not amplify them. They can not bring them on there or kind of show them to their audience. And so they can shape the probability or the outcome of how consensus moves forward, and helping determine whether there has been sufficient consensus on the network yet to move forward with a change or not. And then the two developer groups, even though they both write code, so there's protocol developers and application developers, they have different powers and incentives. So protocol developers focus on maintaining Bitcoin itself. They also generally, their incentives are going to be more aligned towards stability and security. Kind of like Steve mentioned, almost all changes are keeping it performant as it is, not actually implementing consensus changes. Application developers, they're building things like wallets or other layers or things that can fit on top of Bitcoin in various ways. Their power is different because they're not changing the protocol. They're not merging changes into the protocol, but they are generally more inclined on average toward benefiting from more features of the network, because that gives them a bigger design surface to build or to improve whatever it is that they're working on. And one of the things we observed in the paper is that the protocol developers, specifically the maintainers, their main power is in vetoing rather than proposing. So I mentioned before that updates can't be pushed to the user. They can only be put out there, and then the user can choose to pull them to their node. They can update their node or not, or on what timeline they want. And one of the frustrations that exists out there when people determine what changes they want to make or not make is that if changes are just not looked at or not implemented by the maintainers, then those changes have a much lower chance of going through. So they have kind of like direct or indirect veto authority to some extent over what changes go in, but there are ways around that, which I assume we'll explore later.
In her exploration of the complex roles played by the different players in the Bitcoin ecosystem, Lyn Alden explains how their influence and objectives affect the network's course. Because miners can choose which transactions are included in a block as long as they follow consensus criteria, she emphasizes miners as a crucial power block. In addition, miners have the power to implement soft forks even when nodes may not entirely concur, a process she characterizes as fragile, representing a weaker kind of agreement. Lyn also talks about the need of influencers, especially in difficult times like the 2017 arguments over soft and hard forks. Influencers have the power to either magnify or silence particular voices, greatly affecting public opinion and the likelihood that a mutual change will be adopted. They are important participants in the process of reaching an agreement because of their ability to influence opinion and draw attention to particular viewpoints. As we move on to developers, Lyn makes a distinction between two categories: application developers and protocol developers. Instead than actively pushing changes, protocol developers primarily veto ideas in order to preserve Bitcoin's fundamental stability and security. They guarantee that modifications are in line with the network's long-term objectives. However, in order to increase their design options, application developers who make wallets and other tools generally support adding more functionalities to the network. Their efforts influence how people use and interact with Bitcoin, even though they don't change the protocol itself. As Lyn Alden has explained, Bitcoin's future depends on a delicate balance of power among miners, developers, and influencers, all with unique roles and incentives. Until next time, happy investing.